In this session, we're going to forget the jargon, forget the spreadsheets, and just understand in plain English what a fund does and why accounting around it works a bit differently. The idea behind this series is not to turn you into an accountant. The idea is to help you build a clear picture in your head on what a fund is, who's involved, how money moves, and how accounting supports all of that. Once you have that picture, everything else becomes much easier to follow. Today we will cover what a fund is and why fund accounting is a bit different. On the upcoming videos, we will talk about the relevant parties involved, how money flow, what fund accountants actually do, role of the administrators, and end it with the reporting in fund accounting. Don't worry about numbers yet. If you understand this video properly, the rest will feel a lot less confusing. We're just trying to answer two questions. What is a fund, and why do we even need special accounting for it? If you walk away with only one thing today, it's the big picture. A fund could be investing in companies, stocks, real estate, and almost any financial instrument available in the market. It just pools investors and assets together to allow diversification and accessibility. Let's make this very simple. Imagine 10 people put money into one pot. That pot of money is the fund. The fund then uses that money to invest. Over time, those investments are sold, and the money goes back to the same people. So think of the fund as a vehicle that takes money in, invests it, and sends it back. This is where people usually get confused. A normal company makes money by selling products or services to customers. A fund doesn't do that. A fund has investors, not customers. And any profit the fund makes doesn't belong to the fund itself, it belongs to the investors. Just to make it clear, they are not a nonprofit charity also. They do make money from charging recurring fees, which is called management fee, and performance fee based on fund performance. However, this is something we can discuss in the future. So because the fund exists mainly for investors, the accounting also changes. Instead of focusing on sales and expenses, fund accounting focuses on investor money, investments, and returns. The whole goal is fairness and making sure everyone gets exactly what they're entitled to. Normal accounting still exists, fund accounting sits on top of it. It is about ensuring that booking are properly done on investor level and investment level. Not every investor invests in the same amount, and not everyone invests at the same time. Some investors may join earlier, some later. Because of that, you can't just lump everyone together. Each investor's money has to be tracked separately, and that's where capital accounts come in. This layer of timing, which makes doing fund accounting unique since the timing will influence which is the starting period, is the investor going to get allocated his profit or losses for. This can also be one of the main reasons fund accounting is not straightforward. If we zoom out, most funds follow the same pattern. First, money is raised. Then that money is invested. Over time, investments are managed and eventually sold. And finally, the money and any profit is returned to investors. Everything in fund accounting supports this cycle. So where does fund accounting come in? Fund accounting is what keeps score. It records who put in money, where that money went, what it's worth today, and how much belongs to each investor. Without this, there would be no clear answer to very basic questions. At the end of the day, the investors will always ask, what is their investment value after profit and expenses? And how much money do they have in their account? That is why everything should be tracked properly. It's also important to say what fund accounting is not. It's not something that happens only at the end of the year, and it's not just typing numbers into a system, it's an ongoing process that runs throughout the life of the fund. In fact, it can be a time-sensitive matter since investors always want to know how their investment is performing. Some funds does it monthly, and some does it quarterly. A good way to think about fund accounting is like a scoreboard in a game. The scoreboard doesn't play the game, it just makes sure the score is right. Fund accounting does the same thing. It makes sure the numbers reflect what actually happened. If there's one thing to take away from this, a fund is simply investor money being invested and returned. Fund accounting exists to make that process fair, transparent, and trustworthy. Once this clicks, the rest of fund accounting becomes much easier to understand.